Good afternoon and welcome to the Boring Millionaire podcast. My name is James Lamantia and my mission is to not only make you money in the stock market, but to educate you in a way that makes you feel confident in doing it all on your own. So today is Saturday, March 29th, and this past week in the stock market has been quite interesting. So on Monday we did see a rally, and that rally took us above our one-year average on the S&P 500. So then Tuesday, Wednesday, and Thursday we did simmer down a bit, and then Friday we did see a decline in the market. So that decline was triggered by worse than expected inflation data, but even though it's worse than expected, it's really not that bad. Inflation, of course, we all want it to go down. We don't want it to continue rising, but even though it was higher, it was only a touch higher, and people just used it as an excuse to get out of the market. So with that, we did see the panic selling on Friday, and the panic selling did bring us down to the near-term lows that we've seen in this market decline. On the NASDAQ, we've actually hit those lows, and then on the S&P 500, we're about 1.5% above those actual lows. So we're right there, we're kind of chilling at the bottom, but it's only a good thing in my opinion. The reason it's a good thing is because it continues to allow us to have this great opportunity to buy these stocks. I call these the glory moments because the entire market is down across the board. We're only down about 10%. We're sitting at our one-year average, and all the time I've been doing this is very standard, very normal. And in fact, looking at economic textbooks, it's called the correction when the stock market is down 10%. So just by that alone, it's correcting itself. It's doing exactly what it should. And, of course, you don't want it to go down forever. You want there to be a day where it starts to rally and, go higher. However, right now is still the time to be buying and bracing yourself for that rally. So with all that said, another key indicator I saw this week was that though we hit the near-term lows of these recent market declines, the volatility index did not continue to spike. So the first time we hit these lows, the volatility index went as high as 30. Now, when we're retouching these lows, we stayed at about 20 and 21. The highest it went was even 22. So what that means is that though we're retouching these problematic lows, the market is not concerned about it. The market's not feeling volatile. They're not anxious about it. They're almost finding comfort because, these are more practical prices now at this point. And the fact that we're touching it a second time, it's called a double bottom, is also another positive sign. So I expect Monday and Tuesday maybe some timid trading, but I don't think we're going to continue lower. However, you have to plan for all avenues. So if Monday and Tuesday come along and we go lower, I think the lowest we're going to see is 55.02 on the S&P 500 and 16,750 on the NASDAQ. So just looking at all the trading analytics, looking at previous floors, I think that would be the lowest we go if we were to continue to fall. Now, if it goes lower than that, you just have to keep your eye on the market, and, by then I'll have another episode discussing where we're going to be going, but I am very optimistic, and all of my experience is telling me that the lows are in. We might bounce around and see some turbulence, but I don't think we're going to go below 5,500 on the S&P 500. So with that said, I am very eager. I am very excited to be buying stocks. And one way to take great advantage of this market decline is to buy index funds. So with buying an index fund, you don't have to cherry pick particular stocks. You get a blanket across the board. And then that way, when the stock market rallies, you'll be able to see the fruits of your investment through that. Whether some stocks are lagging behind, you won't be affected by that. However, though, if you don't have a lot of money to initially put into the stock market, one way I like to break it down is to take $50. You take that $50, you break it into $5, $10 increments, and then you take those $10 increments and invest them in different companies. And yes, I know $10 in the stock market does not sound like you're going to get rich overnight, but that's why it's called the Boring Millionaire. It's because you will get that wealth. You just have to take the boring, slow steps to doing so. So my first $10 I'm going to take and I'm going to put it into Meta. Meta is the umbrella company that owns Facebook, Instagram, WhatsApp, the Oculus VR goggles, and I just love everything going on there. They're sitting right on their one-year average, which I always say is a great metric to look for when purchasing stocks. So I'm pulling the trigger on them. My next one is PNC. I love PNC as a banking institute, and they pay a 3.75% dividend. So an outrageous dividend, and creates wonderful income in the background just for ownership of those shares. My next pick is Caterpillar. They make all the industrial manufacturing kind of cranes and trucks and things of that nature. They are on a decline. They are under their one-year average as well, and they pay a 1.7% dividend. So just more income being created in the background. I'm buying United Healthcare. United Healthcare is trading at its 3-month average. So it's not just the 1 year. The 3-month and the 6-month average are also important metrics to look at when purchasing stocks. And United Healthcare being on its 3-month average is just screaming buy to me. They also pay a 1.6% dividend. I would also like to add, a couple months ago, there was some bad PR surrounding the stock. The CEO was assassinated, and that did, of course, create a price discount in the shares of the stock. However, that did not fundamentally change what goes on in the company. It does not change the market they're involved in. It did not really change how the company was operated. Of course, there will be a new CEO, but he's not going to, turn them into a athleisure wear company. They're still going to be the leader in the insurance market. So I'm pulling the trigger on them. And then my fifth one I'm putting those $10 into is the TQQQ triple weight NASDAQ fund. So as I mentioned, this is an index fund that covers the NASDAQ index, but it trades at 3 times the rate you would see on the NASDAQ index during the market hours. So if the NASDAQ is up 1%, you should see roughly 3% up on this market ETF. It's not always going to be precisely that because it trades based on option values and things of that nature, but relatively it will be close to the 3%. And, that's a great way to get more juice out of your money for buying something you're already looking to invest in if you're looking to invest in the market. So I'm very eager with everything going on in the market. Although the market is in decline, that's not a bad thing. It's in fact a good thing for those who are looking to purchase and reestablish some positions in their stock portfolio, as well as new investors coming in to start their financial journey. I would also like to say in stock market declines like this, it's important to just take a deep breath and hang on to your stocks. Don't get nervous. Don't panic sell. Don't just let go of everything because there's some bad news in the air. If your financial goal was to have investments in the future and to build your money over time, that goal is still in place. These are just opportunities to put more money, more capital into those positions to get more fruits of your labor from investing. So with all that said, please follow me on Facebook. Please follow me on Instagram. I am always available for direct questions in any fashion you may have revolving around the market. My job is to make you feel confident in what you're doing as well as to make you money in the market. So thank you for tuning in, and I'll be excited to talk to you next week. Thank you.